Bitcoiners, welcome back to another episode of Fed Watch. This week, I am really honored to bring on someone that we've actually wanted to bring onto the show for some time now, and he has graciously accepted to jump on, Mr. Luke Gromen. Luke, this talk was inspired because Bitcoin Tina, of all people, tagged me in one of your threads and said, you need to get Luke onto Fed Watch. And in that thread, you were talking about potentially why the U.S. might get into Bitcoin. Before we get into that, I want to jump into, an introduction of your role into the space. I know Ansel has kind of put together a little bio. I'll pass it to him, and then we can get to you.
Sure. Yeah, Luke, nice to meet you. You are the founder and president of Forest for the Trees, and you are a macro expert. There's so much going on in the world right now. Bitcoin's a little bit quiet, but it seems like, outside of the headlines, but, your expertise is what is, really taking up a lot of the bandwidth right now. So we're lucky to have you on the guest. Welcome.
Thanks for having me on. It's great to be here.
So I guess,
yep.
I guess, Luke, before we jump into this kind of scenario you teased out on Twitter, why don't you introduce yourself, talk about Forest Through the Trees, and your kind of high level introduction?
Sure. So I'm founder and president of FFTT. We're a macro thematic investment research firm that aggregates a large amount of publicly available data in a unique manner, trying to identify developing economic bottlenecks in different sectors and macroeconomically. And something we've been spending a lot of time on over the last 8 years at this point now, has been viewing this ongoing systemic change, the ongoing systemic change that is driving increasing pressure on Western financial and fiscal positions at the sovereign level, in particular, the United States. So we spent a lot of time around that. When you're talking about that it bleeds into a lot of different branches of macro thematic. Energy, debt, etc. So it's that's the 30-second version of who we are and what we do.
Awesome. And I mean, that's really what we like to talk about on this show. It's the macro show that ties in Bitcoin. But Luke, speaking about, these thematic macro kind of threads that you look into, this thread that you dropped on Twitter was very interesting. And you kind of tease out this scenario where Russia has cornered the gold market. And that, in today's world where there is digital gold in Bitcoin, has left the door open for the US to potentially weaponize gold in response to the fact that Russia and maybe the BRIC countries are leaning on gold. Can you talk a little bit about this? And, you've historically been quite a gold bug. And I'm kind of curious overall, like how you started thinking about Bitcoin in the macro sphere.
Sure. So to me, I think there's two big misperceptions in macro today. I think big misperception one is that the real value in the system is the dollar. The real value in the petrodollar system is the dollar. And what I think Russia's doing is the real value is the oil, is the petro. And the other big, I think, misperception, I wouldn't even say it's a misperception, it's no perception virtually, is that for 50 years, really 40 years, I suppose, 40 years, investors have not had to think about the United States sovereign balance sheet at all. Deficits don't matter, the debt doesn't matter. We've heard all of these things over and over. There have been changes that have been steadily accelerating really since the great financial crisis, accelerating more over the last 8 years. It means the US debt actually matters again, and it's a dumpster fire. The US sovereign balance sheet is a dumpster fire, and to be kind. And there are others that are in a similar position, some with worse banking systems, et cetera. But in the end, the dollar is the reserve currency issuer. The U.S. is the reserve currency issuer, and so you're in this this unique historical time where the reserve currency issuer sovereign balance sheet is in very poor shape. And so that, I think, these two factors, that energy is the real value, not the dollar, and the sovereign balance sheet of the United States are really being weaponized by, I think they're part of what has emboldened Russia to do what they've done, knowing that the balance sheet of the United States cannot withstand the loss of Russian energy from global markets. And so I think that is really the genesis of this thread that I would put out, I think, shortly before Russia actually invaded a couple weeks ago. I think that's what's really emboldened him to act. And so that's, I think, sort of where we are in terms of where it ties into Bitcoin. To me, there's been this ongoing move in the system away from treasury bonds as primary reserve asset toward gold. At the global central bank level, at the sovereign level, at sort of the rule maker level, if you will. And in the last, call it probably 2 to 3 years, have done a lot more on Bitcoin as it's when you look at the factors I describe. In a word, they're terrific. They're hugely fundamentally bullish for Bitcoin as a neutral reserve asset for the people, as I think I called it 2 or 3 years ago. Personally, I've actually owned it. I first bought Bitcoin in late 2013. In fact, I saw it the other day. It was, I bought 10 Bitcoin at I think $7,000 or something, right? Which you look back and you laugh now and you go, oh, had I only kept it all. But I've owned it, a little bit of that, straight through. So I've always just kind of kept an eye on it. I never dug into it a bunch. I spent a lot of time more on sort of the macro side, and then that developed to the Bitcoin side, as opposed to starting at the Bitcoin side and developing into the macro.
So, Luke, what would you say those misconceptions are? They like attached to the post-World War II U.S. hegemony, the U.S. liberal trade order, and which comes first? Is it the the realization that those misconceptions are there, or is it that the post-World War II era is ending, or which is it there?
I think Eurasia, broadly speaking, Europe, Asia, Russia, the Middle East, India, broadly understood that the post-war neoliberal rules-based global order, however you want to phrase it, I think they all understood that it ended with the great financial crisis. And you can see this in terms of central banks starting to buy gold again for the first time in 30 years, every year since 2008. You can see it in terms of the response, for example, of, say, Russia in 2014 when oil crashed and everybody said, okay, Russia's going to sell all their gold. And what did Russia do? They kept buying gold and they sold all their treasuries. The Saudis at the end of 2014, everybody said the Saudis are going to wield the oil weapon, and choke off Russia. And they didn't. They wielded the oil weapon and choked off U.S. shale. And so there's been lots of hints along the way in terms of the development of, or pointing to, Eurasia realizing this already and preparing for it. Along the way, the U.S. has been fighting it. And I think what Eurasia has been trying to move toward has been a multi-currency energy pricing with trade imbalances generated in commodity and energy trade, netted out against real trade, and then any deficits or surpluses, depending on which side you are, left over at that point, settled in gold at a floating rate in all currencies. And it's a system that has been advocated for since early 2009 by the People's Bank of China, the Russians, the Europeans, arguably since at least 1999. Really, if you go back in history, you can find them talking about this in 1974. So there is this broad Eurasian support for a system where oil is priced in multiple currencies. Everybody gets to print money for oil, not just the Americans. And then deficits are settled in trade first, and then secondly in gold at a floating rate in every currency. And basically, this is the Bancor system that John Maynard Keynes advocated at Bretton Woods and was overruled by the Americans on, a version of that at least. In fact, the Chinese specifically cited Keynes' Bretton Woods Bancor in their 2009 missive with the BIS asking for a new system. I think in America, we've been a lot slower in getting the joke due to dogma, hubris, the benefits we've gotten from it. I think up until COVID, you would have, I think if you asked the average person in Washington, maybe 1 in 100 would have realized what the US military has been warning about for well over a decade, which is that the dollar is no longer an exorbitant privilege on net. It is an exorbitant burden. Post-COVID, I think we went from 1 in 100 people in Washington understanding that to probably 10 or 15 or 20 people in Washington understanding it. So we're nearing a quorum, if you will. And I think the key catalyst to that was the US military had been complaining about the risks to US supply chains for a decade. We can't fight a war against China, which is silly because you're telling us our primary adversary for the next 2 decades is China. And nobody listened. Virtually nobody in Washington listened. Post-COVID, people started listening, because it went from, hey, this pie in the sky, if China's our adversary in 10 or 20 years, and we're dependent on China, it turned into, we need masks. Okay, call China. And China says, piss off, I'm not giving you the masks until I get all the masks. And that was the point that everybody can sort of understand if you're willing to listen. And so I think there has been this progression from 2008 where Eurasia at a senior level understood the needed for change. You can see in their actions and in the words, the desire and need for change. Washington fought it by and large. Washington is starting to change, led by, I think, the defense and certain circles in the intelligence community that sees the need to basically move to a system with a neutral reserve asset, whether that, a gold is where it appears to be moving at the moment, given what you're seeing in terms of central banks, et cetera. But there's no reason something like there's no reason that Bitcoin couldn't theoretically fulfill that role, whether it be an official level, which doesn't look like there's any momentum for it or minimum momentum for it now, or at a de facto with the people role, if you will.
Yeah, so that kind of brings back to the original thread that spurred this conversation, and Russia being able to corner the LBMA and the COMEX and all that. Can you walk us through what we would see if that were happening? And a lot has happened in those 2 weeks since you made that tweet thread. So is that still looking like a possibility?
Yeah, the tweet thread was really just pointing out that it's not well understood and sort of, and talked about in polite company, but I'm from Cleveland, so, it's that doesn't apply to me, I guess. But in sort of the polite finance circles in the financial money centers, it's not well understood that the Achilles heel of the dollar system as it's been structured since '71 is the unallocated gold markets, centered in London primarily. In other words, COMEX has a lot of leverage, but it's a futures market, right? So there's buyers and sellers. There shouldn't be any real imbalances. In London, there's this unallocated market where it's just unallocated promises of unknown magnitude against a pile of finite gold reserves. And so right now, the oil market's about 20x bigger than the physical gold market in annual production terms, let alone all the gas market on top of that, let alone any other commodity markets on top of that, which have all gotten much bigger in the last couple of weeks, but we're getting bigger on a relative basis anyway. And so the point is that if you wanted to force, it's effectively, again, theoretically possible, as Yogi Berra said, there's, the difference in theory, there's no difference between theory and practice, and in practice there is. But in theory, if you look at the size of the oil market, how little gold there really is at these places, you can basically run a version of what the Hunt brothers did in silver in 1980. And while the Hunt brothers were able to be shut down in their initiatives based on a changing of the rules by COMEX, legal/regulatory pressure, brokers cutting their credit lines. Brokers cutting their credit lines for Russia is the world trying to shut off Russian oil. If you have to stop consuming oil. The problem with stopping consuming Russian oil is, as we're seeing, we're in a supply demand scenario for oil that's not conducive to doing that without causing a super spike in oil, without causing a recession. And a recession with Western sovereign balance sheets where they are not a possibility without the Western sovereigns either defaulting on their sovereign debt or their central banks printing money to cover the difference into that energy super spike. And so I think it ties back to this point of exploiting these multiple systemic weaknesses that have developed over time. Like I said, there's no theoretical reason that couldn't happen. How does that end up impacting the dollar is pretty straightforward. It's basically gold competes with treasuries as the primary reserve asset of the world. And again, not talked about in polite company, but I'm from Cleveland. So the reality is that global central banks have bought 3 times more gold than treasuries since 2014. So this move is already afoot, but gold's not big enough to serve in the role it would need to be. If Russia or somebody else made gold big enough to serve as a neutral reserve asset, that would begin to supplant future demand for treasuries, which would then throw back the need for financing the U.S. deficits, which are structural, growing, and they're going to get a lot bigger. They'd throw them back onto the U.S. And at that point, the U.S. faces a choice: finance them themselves. We don't have the balance sheet without causing recession. Slash spending. And really, when you look at what U.S. is spending money on, just Treasury spending, entitlements, and defense are 120% of tax receipts, and tax receipts are at all-time highs. So you'd have to slash some really big line items and very politically unpopular line items. That's not going to happen, or the Fed's going to print the difference. And again, that gets you back to this sort of Fed printing the difference into an inflation spike. And so when you look at these terms from a big picture perspective, it seems pretty clear to me that sort of the big picture game, the meta game that is being run by Russia, I think supported by China. There's a lot of evidence now that it's supported by China versus a week ago, 2 weeks ago, that it's basically, in a way, forcing this system to change. And so that's sort of I think the dynamics, at least you can kind of see where the pressure points might lie and how they might unfold if something like that were to happen.
So given all that, are you surprised that the dollar's performance over the last week? We've seen a huge rise in DXY, so relative to other large currencies. And, obviously it's fallen against gold, but it has risen against other currencies. And so, I don't know, I just kind of look at that as it's getting less multipolar actually in currencies, right? If the euro goes under because of all this, or that there's stresses in the euro system, then the dollar just grows. And I can see a final showdown between gold, Bitcoin, and the dollar, or something like that. So can you talk maybe about DXY and what you think about that?
Sure. Yeah. To answer your question, I'm not surprised that DXY rose, right? Because it's been the funding currency. You've got this giant euro-dollar system where you've got dollar-denominated loans. And so anytime you're going to get economic stress, the DXY is going to rise against, as a practical matter, it's the euro and the yen. With that said, the dollar has collapsed against oil. Everyone was kind of high-fiving. Look, the ruble fell 50% against the dollar. Not a lot of people high-fiving that the dollar fell 50% against oil in the same time horizon. And this gets back to this point I made before, which is the real value in the dollar system is not the dollar, it's oil. So there's this is the fundamental disagreement, which is the Americans say the dollar's the value, and look, the dollar's going up. And the Russians are saying, no, it's oil. The oil's going up. And that's ultimately why Eurasia wants to move to this multi-currency system, right? Because if the dollar's the value, the Americans have all the power. If the oil's the value, then it's a more balanced system for everybody else. In theory, DXY could be at 200 and there'll be gasoline shortages in the United States. We'll be standing in line with guns waiting for, for fill-ups, right? Because oil, there won't be any. And so that's almost an extreme example, but extremes inform the means of, is the dollar rising or is the dollar falling, and where's the real value? You're seeing it all over right now. Countries are shutting down exports because they're afraid of not getting supplies of commodities. You have the financialized America and investors saying, look, the DXY is rising, we're still the kings, while the world is sitting around dumping dollars to buy wheat, oil, gas, palladium, nickel, gold, silver. What's the real value here? And so I think there is this, again, it's really just two polar opposite views. And I think really what Putin and China are trying to enforce is, as the creditors of this system, is, look, no, the dollar isn't the value. I don't care if the DXY is up. Oil's the value, production's the value, and we want to be paid commensurately. So I think I think we're watching in real time this fight between these two worlds of financialized world and real world.
I think that that's really interesting. And, a lot of people in the Bitcoin space, Parker Lewis wrote an excellent article titled Bitcoin is the Great Definancialization. We look at mining as kind of this thing that ties Bitcoin to reality and production a little bit more than what the current system is set up to be, and kind of transitioning out of, what we're seeing immediately and zooming out a little bit. People have been talking about, this is the end of the World War II, post-World War II kind of era. The US dollar hegemony is over. These sanctions are exposing, the lack of ownership within the existing dollar system, which brings into the question, what is real value today? And the dollar kind of losing trust. Can you talk a little bit about, what happens next? Is Russia and China's kind of call on this system, does that bring down, the second best? Does that bring down Europe? Like what's that like next step? It seems as though you've been able to kind of be on top of things. The thread that inspired this is now prophetic 3 weeks later. So I guess what happens next here?
Well, I think, and this ties into Ansel's point about, I think ground zero of what has already transpired is Europe, right? In terms of energy costs and economic collapse, right? I mean, you're seeing hyperinflation in energy costs, full stop. I mean, energy costs, electricity costs in Italy are up 50% in the last week. I don't know how many months in a row you need that to happen, but the IMF definition is 50% a month of something for hyperinflation. So you are, in the very short run, at least, seeing a hyperinflation in electricity costs, gas costs, nickel costs, palladium costs, a lot of different things in Europe. And production is not going to be able to be sustained. Margins are not going to be able to be sustained, consumer spending, et cetera, in Europe. Now, back in 1998, when I was, 3 or 4 years into this business, Russia defaulted. And within a month, with the world much less levered, demographics much better, China nothing but an emerging market backwater, oil at 20, not 120. Within a month and a half, the financial system nearly collapsed through the link of long-term capital management. It required a Fed bailout orchestrated by Wall Street. After a relatively irrelevant Russia compared to today, particularly since they weren't paired with China, collapsed. Or defaulted, excuse me. So there's this view, and I see it almost every day. It's like, well, the Fed was talking about it this last weekend. It's just Russia. And to me, that is just so misplaced. You're already seeing the contagion in Europe. The contagion in Europe is going to spread to European banks. I mean, I saw a headline, I tweeted about it yesterday. Deutsche Bank said, we've significantly reduced our Russian exposure. I'm like, no, you haven't. I mean, unless Deutsche Bank has no more Deutsche customers who are buying energy from Russia, which is inflated by 50 to 100% in the last month, you still have a lot of Russian exposure. And so there's this wishful thinking / lack of second derivative thinking, or inappropriate first principles thinking, however you want to define it, there's going to be a contagion, and you're going to see in the European slowdown. Then you'll see it in European banks. The European banks, listen, the American banks are in great shape. They are. With that said, you're going to see shoot first, ask questions later, because I've got 30 years of experience, 25 years of experience. Like when you have a banking problem somewhere, it ends up being a banking problem somewhere else. The only question is how long. You'll see stocks taken out here. You've already started to see that. I think it will get worse. Stocks drive marginal consumption in the United States. They drive marginal tax receipts. And I think ultimately where this goes is this dynamic that nobody's looking at is the sovereign balance sheet side. If tax receipts start falling, when you can't even cover your treasury spending, your entitlements, and your defense, let alone everything else the federal government spends money on, with tax receipts at all-time highs, inflated by 12% nominal GDP growth last year, what are you going to do? You're going to have a choice. You're going to have either slash defense spending in the middle of a showdown with Russia. Nope. You're going to have the Treasury come out and say, effective next month, we're going to only make every other interest coupon on treasuries, and we're going to cut all Treasury stimulus effective immediately. Nope. Because cutting the stimulus will make GDP fall faster, make tax receipts fall faster, which will make your problem worse, not better. Or you say to baby boomers 7 months before an election, starting next month, we're going to start skipping every other month on the Social Security payments. Nope. Or you're going to go to the Fed and say, yeah, I know oil's at 125 on its way to 140, but you're going to finance the difference. That's what's going to happen. That's what's going to happen. And 99% of Wall Street is going, there's no way the Fed's going to loosen into a inflation spike. They're not going to have a choice. And this is the big, not even misperception, no perception. There's nobody doing any real work on the sovereign balance sheet of the United States. There's nobody doing any real work on the balance of payments of the United States because it hasn't mattered for 50 years. It matters now due to some of these other things we're talking about, and these actions that Russia and China have simply taken what was inevitable anyway, and brought it forward in a big hurry in an election year, which only puts the pressure on them.
Yeah, you mentioned Deutsche. I saw a story about Credit Suisse and how they are exposed to Russian CDS. So, I mean, those European banks, they're in such a bad position, exposed to Russia, exposed to these credit default swaps, the weapons of mass financial destruction. I am very, very bearish on Europe. And that's why I'm somewhat bullish on the dollar at this point, because where is all that European capital going to flow? I think it's going to flee and it's going to go into dollar denominated assets. And I mean, that could boost up price increases in everything, but the CPI can continue to go up. Yeah, and it puts the Fed in a quagmire. So I don't know what to expect, but Bitcoin in this situation, and gold too, as gold is outperforming right now, it's just the best of all worlds for those prices, right? Wouldn't you say that gold and Bitcoin stand to benefit amongst the top asset, probably outperform everything over the next couple of years?
Yeah, I mean, I don't know about the next couple of years, very possible, but we've been saying to our clients over the last 2 weeks, really since Russia went in, the only things to us that I feel comfortable owning, the only thing I own that I feel comfortable owning or adding to personally, in terms of owning at the moment, is really comfortable, at least. Let me put it that way. The only things I have a high degree of comfort owning, because I still do own other things, are dollars, gold, Bitcoin. And it's probably in order of gold, probably gold, dollars, Bitcoin, just based on some of the near term, some of the near term correlations between Bitcoin and tech and risk assets broadly. I think that correlation it started to break a little bit last week. I think it's going to continue to break, the correlation between Bitcoin and big tech. Over time, the fact that you started to see that relationship break down a little bit last week, I thought was a potentially important sign. We'll see if we get some follow through. But yeah, I agree. I mean, there's just, it's been very interesting so far this week. U.S. Treasury long bonds have gotten hammered, which for all of my career up until March 2020, arguably, were when you had a risk off like this, when you had a crisis like this, the world flocked into long dated treasuries. They're not going there. There's an issue. So it's a pretty unique time.
Switching gears, this is there is no segue here, but what if the Russian or the Ukrainian situation ends sooner rather than later? You know, I think everyone's kind of pricing in a quagmire that's going to take 6 months, a year, maybe 2 years or something like that. What happens if, you know, I just saw today that Zelensky is willing to talk, maybe make some concessions on his hard stance on the NATO stuff. So what if, you know, a week or two from now, there is some sort of deal on the table and markets are completely on the wrong side of this trade? And in the meantime, right, we have also been talking to Venezuela and doing this Iranian deal. Like, what happens if in 2 weeks from now, we're, instead of facing a shortage of oil, we're facing the prospect of huge oil surge in production right as everything's wrapping up?
Yeah, I think from a tactical perspective, that kind of thing is very possible, right? Where you can get some sort of de-escalation resolution favorable to both sides. You take the war premium out of commodities, broadly speaking. I think oil probably falls the most in that case, but I think gold would fall too. You probably get growth stocks and stocks broadly in the U.S. to rise. Tactically, I would expect that sort of unwind to happen. Now, from a intermediate terms, I think that would be relatively brief in terms of that unwind. It could be sharp, but I think it'll be brief. And the reason I think that is think about what we're saying here. Russia went into NATO, said we're going to put them in NATO. Russia said no, and Russia won. What we will be seeing is a mark to market of relative global power levels, because I don't think there's going to be any de-escalation without Russia getting what they want on this. At least Putin's been pretty clear about that. And Zelensky has said, okay, in the comments today, we're willing to go, we're willing to be neutral. I'll sign that. That's fine. When you see signs that the United States, I mean, we have been actively trying to upset or undermine the Venezuelan government, the Venezuelan regime for 20 years, 10 years. We have been actively trying to undermine, hurt, sanction the Iranian government for 40 years. So in the U.S. government, who consensus has all the, King Dollar, hashtag America, the dollar's King Dollar. Why is King Dollar panhandling for oil in Venezuela? Why is King Dollar panhandling for oil in Iran? And again, I don't mean to be so harsh, but I think it's important we take a step back to see the big picture, which is this event over the last 2 weeks is showing a change in relative global power levels, which was Putin's entire point. You couldn't survive 2 weeks without going to Iran, without going to Venezuela, who, by the way, are Russian client states in both cases. I mean, I would have loved to have been a fly on the wall for that. We go to the Saudis, and what the Saudis tell us, don't bother. We're good. We're going to stick with the agreement. All right. So there's away from the tactical unwind, which I agree you could see. I think there is, again, pointing to this important secular change that just happened that I don't think, again, because everyone's understandably trying to manage their risk, their positions, things are moving around. I mean, if you don't manage that risk in the very short term with these movements, you get carried out. You're not going to get to see the intermediate term. But I think once things settle down, if we do get a de-escalation, we get this unwind, people are, they're going to sell oil and they're going to buy stocks and they're going to sell gold. And they're going to sit there and go, wait a second, like whatever we thought leverage we had 3 weeks ago, we need to mark that amount of leverage we have down by, I don't know, 20%, 30%, 40%, whatever, relative power levels. And you say, okay, Eurasia is much more influential. What does that mean? America all of a sudden realizes, oh God, this whole green thing is, the wrong direction. And you start seeing reshoring, reinvestment, reindustrialization in America accelerated meaningfully. Well, none of that can happen with the dollar system as it's structured. None of it. Our job is to run deficits, supply dollars. That's it. So if we're going to do these things that have to address these weaknesses that have been exposed by the last 2 weeks, right? The whole we're going to reshore, or I'm so angry we have no leverage to address what Putin's doing, and the dollar's going to be reserve status. The post $71 system as structured is an asset for America. Those are fundamentally mutually exclusive positions. You have to change the dollar system if you want to address the weaknesses and the imbalances that have been exposed over the last 2 weeks, 3 weeks. And I think they will start to do that, right? So we'll start to see things like, hey, President Biden, $500 billion stimulus for a fast track for a semiconductor industry. Where are we going to get the money? Fed's going to print it all. President Biden, $500 billion stimulus for energy infrastructure and pipelines. Where are we going to get the money? Fed's going to print it all. Now, maybe we pull back on some defense stuff to net it out. But again, these are things that the dollar system post 71 was, you guys make the stuff, we'll buy it from you, and then you recycle the dollars. And this, to address the issues that have been revealed over the last 2-3 weeks, that we can't, Putin's got us by the short hairs. We can't cut out his oil without collapsing our own system. To address that issue and to address it with China, which we haven't even touched on yet, the dollar system has to be fundamentally reordered. And I think this is understood, at least in certain circles in Washington and elsewhere around the world. And these things, and that's when I say, tactically, you get this unwind. But as markets sort of settle down and go, oh God, I don't want to sell oil. I need to buy oil. I don't want to sell gold. I need to buy gold. I don't want to sell Bitcoin. I want to buy Bitcoin. I don't want to sell, and I want to buy American industrials because they're going to be building a bunch of this stuff. So the thing you want to sell in that case is, oh God, I got to get out of bonds. They're going to get, not that they'll get beat up on a nominal basis. I don't think they will. But think if you own a bond fund and the Biden administration starts addressing, printing money to address these very real geostrategic issues that were just revealed, the bond market's expecting transitory CPI. What Biden will be announcing is CPI is not going to be 7.5% this year going to 2. It's going to be 7.5 going to 10 for the next 5 years. And the bond market is going to go, oh God, it'll be like the E-Trade baby going like throwing up on itself. And of course, the problem is that the sovereign balance sheet of the United States can't afford more than probably 3%, maybe 4 if we're really lucky, right? Every 100 basis points of interest rate is pro forma 9% of tax receipts. And that assumes tax receipts, which are highly interest rate sensitive, don't fall as rates rise. So it's probably more like pro forma 10 to 12% for every 100 basis points, rising non-linearly as rates rise. And so what's that mean? That means to finance this stuff, the Fed's going to have to cap yields. It's just, you basically will be moving to a wartime footing after the war. And so I think we're in for a very highly inflationary, secularly, structurally, 5-10 years.
Well, what would you say, which price is more accurate, the oil price or the bond market?
Oil. Oil's got a low stock to flow ratio. Oil is needed. There's only so many places you can store oil. So that's why I say you have the low stock to flow ratio. You can only have so many derivatives to influence its price. The bond market, the Fed's balance sheet going from 3 to 9 over the last 2 years, 3 trillion, 9 trillion, 4 trillion to 9 trillion over the last 2 years. There's a non-economic buyer there. Where's he getting his capital? Printing press. To me, I don't know how much that has helped bond prices, but to me, it's strange credulity to say that the Fed's buying of $5 trillion in bonds over the last 2 years has not helped bond prices. To me, and if you say, okay, it hasn't helped it because the world would have crashed and everyone would have bought bonds. Yeah, but that ignores, again, the second order effect of you need stocks to go up to have the tax receipts to pay the interest on those bonds and. So there's a little bit of this, chicken and egg problem, but I think if you X out the war premium in oil, I think oil was up 100% before Putin really started rattling any sabers, up 100% year over year, right? It had gone from 45 to 85, so whatever, 80%. So I think oil's a better I mean, I know to hedge my inflation, I'd much rather own oil than bonds, wouldn't you?
Oh yeah. Yeah. I asked because, the bond market is the deepest, most sophisticated market out there. Even though oil is obviously very deep and very sophisticated. But yeah, it's an interesting duel there, which price is actually the smart money and which price is kind of short term. Because oil price does remind me a lot of 2008. If you look at the chart, right, the 2008 financial crisis, oil goes through the roof, which is right around where we're at today, actually. And then we had a precipitous drop. And I've been an actual oil bear, and I've been on the wrong side of that trade for, now 2 years since Corona. But, I think if you look at like the total amount of oil used in the world pre-Corona, it was around 100 million barrels a day, and now it's 96. It hasn't recovered. The US has spare capacity that it can bring back online if, the ESG people just get out of the way. So, I tend to think the opposite way. I tend to think that the bond market is more correct and the oil is just in a blow off top right now. So, what are your thoughts on that?
The thing for me is like I said, I think it could be in a blow off, a blow off top related to the war premium that could reverse in the short run due to, if you get a de-escalation. If we don't get a de-escalation, it's going higher, in my view. The thing that is very different than 2008 is the US's sovereign balance sheet. I want to say when oil crashed, then we had the nasty recession, because of the nasty recession, the great financial crisis, US debt to GDP was, I want to say 60%, maybe 70%. It's 122% now. And US debt to GDP or deficit as a percent of GDP then was probably 2% in 08. It's 12 at the end of last year. And last three recessions, you've had deficit as a percent of GDP has risen 300 at the low end, 1,000 basis points of GDP at the high end, right? So you'll be looking at deficit as a percent of GDP going from 12 to 15 to 22% of GDP. So 15% of GDP is 3.3 trillion in deficits, and 22 is 4.5 trillion in deficits if we have another recession caused by oil. And that's where it gets into this dynamic of, okay, let's say oil does cause this recession. US, this balance sheet, this fiscal issue, how do we resolve this? And who buys 4.4 trillion? Who buys 3.3 trillion in treasuries? Are the Russians? Chinese? No. I mean, the Americans just told people FX reserves are not money good. They just told the whole world we're sanctioning Russian FX reserves. Don't buy them. So now, who's going to buy those FX reserves? It's the Fed with printed money. And that's where I think, we're getting into this weird time where the model of the last 40 years is breaking in real time. This is something, this is all I'm doing is looking at America and just taking away the American flag off the masthead. Like if this was Turkey we were describing, another twin deficit nation, this would be hard, when Turkey has a recession with a twin deficit, Turkish bonds sell off, the currency goes down, right? In dollar term, dollars go up against the Turkish lira, like we saw last year. Same thing with Argentina. It's simply, again, that, I think I said to someone earlier today was like, look, there's a great there's a great piece of work that was done by Hirschman Capital, citing Rogoff and Reinhardt's work of 8 or 9 years ago in the sovereign debt. And in the summer 2020, he said, look, over the last 120 years, there've been I don't know 100 and how many was it? I guess it was 53 episodes maybe over the last 120 years where a nation's debt to GDP got to 130%. 98% of those were resolved via high inflation or hyperinflation. Basically restructuring the debt, lowering the debt via high or hyperinflation. And so you have on one side this 98% chance, but that's what's going to happen. And we started to see it in 2021. And a 2% chance it won't. And everybody's betting on the 2% and pointing at Japan going, well, Japan didn't, so we won't. But Japan's literally 180 degrees opposite setup of the US. So it's, I think I think we're going to get a recession given what oil's already done. But again, then I think it's critical to look at the second derivative that nobody's looking at, which is US sovereign balance sheet is not where it was in 2014, in 2008. In 2000, I mean, in 98, when Russia defaulted and almost collapsed the system here, the US was running surpluses. We literally were running, the government was borrowing nothing. They were running a surplus, and it still was nearly enough to collapse the system. So I just think it's the second derivative of the sovereign balance sheet of the US that is really underappreciated.
I have a quick comment, and then I'll pass it off to CK because I know he's been chomping at the bit here. Out of those 53, how many were global reserve currencies?
I believe the UK went through it. I'd have to double check the data, but if you look at post World War I, really to me the world looks a lot like post World War I in some facets. We're in a global sovereign debt bubble. We had a stock bubble, kicked it upstairs, the banking system, housing bubble, kicked it upstairs, the sovereign debt. There's nowhere else to kick a sovereign debt level other than the currency. And you say Europe had I would say the last global sovereign debt bubble was after World War I. UK held on for the longest as global reserve currency, but it required unemployment at 8 to 10% for 10 years before they finally devalued. There's no political will here to set that type of austerity. Again, you would have to slash defense, you'd have to slash entitlements, you'd have to slash probably Treasury stimulus. So you would again, given the complexity of the system now versus then, I don't think that's possible. And even then, they eventually devalued the pound significantly. They eventually ended their reserve currency role. And by 1939, when they went to war with Germany, my understanding is the Americans would not accept the British pound in the Lend-Lease program, only dollars or gold. So the Americans, the creditor, refused the global reserve currency with a 300-year history, 250-year history in war, our best friend, no less. So I think, now to your point, most of them were not the global reserve currency. That has clearly bought us a lot of time. The $64,000 question is how much more time does it buy us? And I think that then ties into some of the dynamics we're seeing geopolitically, oil, balance sheet, et cetera.
So, Luke, I mean, as listening to you, really at the heart of what you are articulating is, a shift in global trust and how trust is allocated. And, you're talking about on different timescales that trust really changing and then behavior changing, kind of geopolitically. I see, and we've talked about on this show, a much more localized world, which you kind of talked about is, the Fed will start financing, building out chip foundries and infrastructure and oil capacity, et cetera. Can you talk a little bit about a world on this kind of like localization standard? And, is there an opportunity for something like a CBDC to come in? People talk about where, China's CBDC comes into play here, or, I mean, again, our thesis here is that it's really a dollar and Bitcoin game to play despite localization. It seems as though there's some alignment with the thesis here that, kind of the global world order is shaking up a little bit, and there's this opportunity to kind of grab that pristine spot as like this global reserve. want to pass it back to you.
Sure. Yeah, I mean, if you think about Bitcoin, right? To me, one of the message of Bitcoin is energy is more important than fiat, right? I mean, at its core, that's what proof of work is, right? Energy is the real value, not whatever I say it is, right? And so I think this breakdown in the rules-based global order as it's been structured for the last 30, 40 years in particular, I think is really just a bunch of nations acting in their own mostly enlightened self-interest, which is to say, you know, when you go back 4 years, you can see Kyle Bass on CNBC saying, look, you know, the Chinese buy a lot of oil and it grows every year, and oil's prices are going up, and oil's only priced in dollars. And so if we can just squeeze the amount of oil price higher, then the Chinese are going to run out of dollars and they're going to have a currency crisis like the Southeast Asian countries did in the late 90s. And the Chinese are just going, yeah, no, that's not acceptable to us. And we can think whatever we want about the CCP, and I'm not necessarily a big fan of some of the things, all those things, doesn't matter. They're not going to sit around and let, you know, something like that, you know, be choked off. Europeans are in the same position. The Japanese are in the same position. And so they need to find this. I think this relocalization, this breakup of the rules-based globalization of the last 30, 40 years is really a matter of national security to be able to print their own currencies for oil and energy and commodities that they're all short, but doing so in a way that doesn't require them to do what the Americans did. What we chose to do was to basically send all of our factories to low-cost countries to create the deficits, right? We had to dishoard ourselves of factories to do this. They don't want to do that. That's politically unacceptable for, in particular, Japan, China, Europe. So they're not going to do that. So, okay, you have to settle in something. They don't, their domestic internet, you know, sovereign bond markets aren't big enough, aren't trusted enough. There's rule of law issues. There's, again, there's deficit issues relative to what I just described in terms of deindustrialization that has not happened there for political reasons. And so you have to find a neutral reserve asset. You have to settle in something that everybody trusts. And so I think your point of trust is a really good one. And so then it gets to, okay, what do they trust? You've got gold with a 5,000-year history, and that's clearly been, they're moving toward that. And I think Bitcoin can work in that way. If it can work in that way, full stop. The question then is how does that path look, given that is not where the established authorities are moving at the moment? They're moving toward gold. And how does that, you know, can that be then gamed or forced or encouraged by American authorities, which may have an interest in doing that, you know, depending on situation and events.
Yeah, very interesting. One of my critiques of the gold standard, I mean, I'm coming from a gold bug world. I was a gold bug until I became a Bitcoiner, but is that there is, you know, gold is captured. It's sitting at the central banks. And why, if someone is so mad at the United States for freezing their reserves, their you know, foreign reserves right now, what's to stop the United States from freezing their gold in New York City, right? And so I think that there are a lot of big hurdles to the gold system. What's your response to that?
Yeah, well, it's absolutely an issue, right? I think ultimately, you know, when you see U.S. senators today saying, you know, we should tamp down on Russia's gold. Number one, most of Russia's gold's in Russia, so good luck with that. But these senators are encouraging a run on the gold of the New York Fed. I mean, again, the number of actors, you know, people say, well, it's only bad actors. The number of countries that have not been considered bad actors by the United States at some point in the last 80 years is exceedingly short. Exceedingly, like I just said, we stuck it to the Brits in World War II. Like, we don't want your reserve currency sterling, gold or dollars, right? But everybody, you know, it's a very short list of countries. And so when the U.S. does things like this, which is an absolute risk with gold, and it's a risk for investors in terms of paper proxies for gold, most of which have some version of cash settlement language in them, force majeure language. If you don't hold it, you don't own it. Full stop. And so I think you're likely to see, basically a version of global, if you don't hold it, you don't own it, evolving in coming years as a result of what we've seen in the last 2 weeks.
I agree.
Yeah.
Yeah. I mean, I think that's the lesson right now. So the lesson is, if you don't hold it, you don't own it. This conversation makes me bullish on Bitcoin because it's the easiest thing for anyone to hold. And I do think it's really a global trust shift that it comes down to. Luke, we have to wrap up. I want to give you back the mic to close out this conversation, and I want to say thank you so much for the time. Really appreciate your insights, and I found this incredibly valuable.
Well, thanks for having me on. It was great to be here. Enjoyed catching up, and wish you all the best of luck.
I guess, can you tell the audience where they can learn more about you? Sure. And yeah.
Absolutely. It's you check us out at FFTT-LLC.com. It gives updates in terms of what we're up to, some of our research product offerings ranging from institutional to mass market product offerings. And I've got a pretty active Twitter feed at Luke Gromen, LUKEGROMEN, for you can kind of see ongoing thoughts there as well.
Must follow Twitter account, that's for sure.
Thank you.
All right, awesome. Well, again, Luke, thank you so much. To all the Bitcoiners out there, make sure to follow Luke, make sure to follow me, make sure to follow Ansel, make sure to subscribe to the show, and passing it back over to Q. Thanks again, Luke. Peace.
All right. Thanks, guys.